European Monetary Union, Ideology and Class by Werner Bonefeld. Preface. European Economic and Monetary Union amounts to more than just an exchange rate mechanism. It substitutes participating currencies with a single currency, or in other words, replaces several decision-making authorities by a single one, the European Central Bank. Participating countries lose control over monetary policy and are no longer able to use exchange rate devaluation for adjusting productivity growth to globally competitive levels. The ECB is charged with maintaining price stability across the European Union. Macroeconomic adjustment in member states will have to be based on greater labor flexibility, and that is on the achievement of competitive labor unit cost. Adjustment, in other words, is expected from the European working class through higher labor productivity, wage restraint, and neoliberal welfare reforms. The preparation for the launch of the new European currency, the euro, has helped justify austerity across Europe. The Maastricht Treaty adopted tough convergence criteria. It laid down both the timetable and a set of targets for convergence in the field of government expenditure, accumulated public debt, limits on inflation, and limits on long-term interest rates. The criteria for convergence towards EMU were strengthened by the Stability Pact, which was negotiated in 1996 to overcome the German objections to EMU. The German government was concerned that fiscal expansionism, especially in the southern European states, would make the euro weaker than the German mark. The Stability Pact toughened the convergence criteria and made them permanent features of EMU. It empowered the ECB and the Commission to police member states' fiscal policy. In case of fiscal profligacy, member states can be fined. However, the pact made allowance to exempt by qualified majority vote countries running an excess deficit in cases of compelling evidence of a severe economic downturn. EMU appears partly defensive insofar as it seeks to protect member states from risk of floating exchange rates that allow speculative capital to exploit currency differentials. EMU, on this reading, attempts to reduce the vulnerability of the European economy to the whims of short-term, globally mobile money capital. At the same time, EMU appears as an offensive device that seeks to make the European working class work harder in the face of deteriorating conditions. EMU encourages greater competitiveness on the basis of disinflation and increased labor productivity. The project of European Monetary Union has then to be looked at against the background of the crisis-ridden development of capital accumulation since the late 1960s. It was this crisis that led to the emergence of global footloose money capital and new forms of financial crisis. There is thus, as Carcetti put it, a clear link between the present, still unresolved profitability crisis and the new form of monetary turbulences on the other hand, and the project of EMU on the other. Introduction. Commentators on EMU argue that it is driven by politics rather than economics. Yet while this claim is made, and rightly so, there is surprisingly little in the literature concerning the politics of EMU. Of course, the political is emphasized in the terms of institutional politics, in the division of competence between the political institutions at the supranational and national levels. And it is addressed in terms of the so-called democratic deficit, especially the democratic legitimacy of the independent ECB. Interstate bargains and rivalry, and in terms of inter-imperialist rivalry between the EU and the USA and Japan. In short, the conventional view of politics prevails, and therewith an understanding that the political and the economic are two distinctly different forms of social organization. Such a view needs to be treated with suspicion. For example, while the economists treat human purposeful activity as a factor of production, and the focus of political scientists fall on the democratic and legal constitution of the social and political rights and duties of citizens. However, the so-called human factor of production is no less a citizen as a person endowed with equal rights, and conversely, the citizen is no less a factor of production as a wage-laboring commodity. In short, conventional accounts of EMU take for granted the bourgeoisie conception of a social world where the social individuals are not divided according to class. Rather, they're conceived to be divided within themselves as economic agents. on one hand, and citizens on the other. Each of these apparently distinct identities is seen to derive from the distinct political and economic structures, and each of these structures is perceived to have its own logic of development. Although these logics interact, the fundamental objectives of EMU were political and the strategy was economic. The social world is nevertheless treated as a fragmented thing where human beings do not exist as such. Their being is differentiated between the economic actors who follow the logic of economic rationality and citizens who pursue their specific social and political interests within a democratically constituted political state. From this perspective, the notion that EMU is a politically driven project allows merely for all discussion of the political in terms of either institutional political economy or neo-realist accounts on the cooperation and conflict between states or moral and political judgment on the impact of EMU. These judgments, which derive on the whole from a Keynesian perspective, do not reject EMU as such. What stands rejected is the neoliberal design of EMU that, for Keynesianism, is seen to increase unemployment and social distress across Europe. However, has the recession of the early 1990s in Europe really been caused by the transition towards monetary union, and would a Keynesian design of EMU help to create conditions of full employment across Europe? This chapter analyzes the politics of EMU. Politics is understood here as class politics. Conventional accounts deny the importance of class politics through their premise that the economic and political are two distinct forms of social organization. Yet their understanding of the economic significance of EMU reveals the class content of monetary union. Thus, as far as the content of the debate is concerned, its focus is entirely on the reintegration of labor, the European working class, into the capital relation. EMU focuses the burden of adjustment exclusively on labor. On this issue, the conventional debate on EMU is unmistakably clear. In short, the conventional debate on EMU does indeed raise the question of the political. While it ostensibly adopts an institutional view, its focus is on the subordination of social labor power to the dictate of the exploitation. Conventional accounts on the institutional arrangements of EMU appear to accept the idea that politics has nothing to do with monetary policy. There is no doubt that EMU appears as an arrangement that not only removes any political significance from economic relations, but also depoliticizes the political itself. In EMU, politics is initiated in the name of Europe, made through European cooperation, and especially monetary policy is presented as an institutionally anchored device that leaves monetary policy to those who professionally have the insights into and possess the expert knowledge required for the regulation of apparently impartial economic mechanisms. However, the institutional setup, for example, the ECB, is not just an institutional in the commonly understood sense. The language of institutional rationality, institutional legitimacy, optimum currency area, etc., disguises what amounts in fact to a most important radical attempt on the part of the European bourgeoisie at providing an institutional solution to the crisis of capitalist accumulation that since the late 1960s has beset capitalist reproduction like a cancer. In sum, the conventional debate on EMU disguises the class content of EMU either by focusing on the formal aspects of monetary union or by providing moral judgment on its negative impact on, for example, the employment of European labor or the European nation-state. This chapter analyzes the class character of EMU. There is no doubt that the EMU is meant to provide institutional channels for the contamination of the so-called labor question, and through it, the political guarantee of the bourgeoisie property rights of exploitation. EMU seeks to take politics out of the making of monetary policy and attempts to remove social labor power as an active subject, conferring on capital the realization of its impossible dream of exploiting labor uncontested. However, without exploiting labor's productive power, and thus without confronting labor, capital would be no thing, and thus rendered incapable of asserting itself as the self-valorizing value as which it presents itself. This conclusion suggests that EMU institutionalizes the contradictory existence of capital. That is, it's dependent on labor's value-creating power. EMU, then, is not just a mechanism that regulates the monetary conditions of capitalist accumulation in the EU. It is also an arrangement that transmits regional class conflicts across the EU and beyond, so reproducing what EMU is expected to resolve, and that is the labor question. The following section summarizes the history of European monetary integration, especially since the 1970s. There then follows an analysis of the capitalist crisis of accumulation. We then examine why the problem of economic adjustment has been addressed in terms of the Europeanization of specifically monetary policy. This issue will be examined through the lens of the neoliberal crisis conception of the 1970s. The next section analyzes the politics of EMU. The conclusion summarizes the argument and suggests that EMU is not only a response to the crisis of capitalist accumulation, but also a preemptive device for the disciplining of labor, a device, however, that allows regional class conflicts to assert themselves across Europe. European monetary integration in historical context. The history of European monetary integration since World War II can be schematized into 5 different phases, each corresponding with major developments in the global political economy. During the 1950s, the international financial system of Bretton Woods was not in full operation, as European currencies were not readily convertible into the dollar. During this period, the European Payment Unions, EPU, supported efforts of European post-war reconstruction. It was mainly a clearinghouse for balance of payment deficits between participating countries. By 1958, the convertibility of European currencies was restored. The EPU was abandoned, and during the 1960s, European monetary integration worked through the system of Bretton Woods that tied the exchange rates of European currencies to the dollar. It was by the late 1960s, particularly early 1970s, with the collapse of the Bretton Woods system, that serious attempts at European monetary integration started. During the late 1960s, the dollar was under increasing pressure, particularly due to the resurgence of German and Japanese competitiveness, the financing of the Vietnam War through an inflationary supply of dollars. This supply accelerated the growing spillover of world money, the dollar, from financing the productive accumulation of capital into financial markets. The inflationary supply of the dollar put pressure on European countries, a pressure that was debated at the time as an export of the U.S. inflation to Europe. Against this background, then, the European Economic Community supported the Werner Plan of 1971 that sought to establish a European system of monetary integration within the framework of the Bretton Woods system. However, as soon as the ink had dried on the Werner Plan, the Bretton Woods system broke down between 1971 and 1973. The breakdown meant that the dollar was no longer backed by gold, and more importantly, that currencies, rather than being tied to the dollar, started to float against each other. The dollar, however, was not dethroned from its position as world currency, allowing the United States to respond, for most of the 1970s, to competitive difficulties and social discontent through exchange rate devaluation and inflationary erosion of working-class income. The inflationary supply of dollars posed a major difficulty for European countries. They too had responded to the tremendous level of discontent in the late 1960s, early 1970s through fiscal expansionism. Yet this response intensified the crisis of money in production. This was discussed at the time in terms of the fiscal crisis of state and stagflation. High rates of inflation, mass unemployment, and sluggish economic growth coincided, leading to increasing pressure on state expenditure as the tax base eroded and claims on the welfare state expanded. During the 1970s, European countries established the so-called snake, a European exchange rate system. In this system, the participating currencies fluctuated with an agreed margin around each other, and all fluctuated within the set of margin against the dollar, hence the description of the snake as a snake in the tunnel. The snake was a quite unsuccessful device. Particularly, countries were forced, time and time again, to suspend membership in the face of the speculative pressures that responded not just to sluggish economic performance, but through it, to working-class resistance to the intensification of exploitation and wage restraint. During much of the 1970s, the U.S. authorities sought to recoup international markets by letting the dollar fall. This reinforced inflationary pressure on European countries and made it harder for them to bolster their reserves through export earnings. European countries found it therefore difficult to fend off speculative pressures. The snake, then, had to cope with domestic conflicts, which compelled governments to commit themselves to existing labor markets and welfare guarantees. At the same time, financial and economic conditions deteriorated, with hyperinflation increasing speculative pressure. The snake failed to provide an anchor for currency stability, and through it, disinflation. In the late 1970s, the snake was replaced by the European monetary system. Its central feature was the European exchange rate mechanism. The initiative for the European monetary system came from Germany and France. Against the background of the pound-sterling crisis of 1976, the dollar crisis of 1978, both governments saw it as a way of reducing currency fluctuations and as a means of confronting domestic difficulties. The EMS was to replace the discretionary influence on monetary policy by a rule-based system. For Germany, the EMS was a means of consolidating its economic position in Europe and through it, its global economic role and political aspirations. The EMS tied the weaker European currencies to the German mark. However, up until 1983, the EMS was a rather weak system, and currency devaluations occurred regularly. The 1980s saw conflicting policy responses to the power of the working class to demand conditions. In the US during the last years of the Carter administration and then under Reagan, class politics through inflation and dollar devaluation were replaced by a politics of austerity. A similar policy of austerity was adopted first by the British Labour government under Callaghan and then reinforced under Thatcher. In France, however, working-class discontent had led to a politics of fiscal and monetary expansion under Mitterrand. Against the background of the severe crisis of the early 1980s, both the French and Anglo-Saxon responses to the so-called labour question were short-lived. In France, the experiment of Keynesianism in one country led to increasing speculative attacks, with public debt increasing and inflation devaluing profits in the face of the deteriorating competitive position of its national economy. The socialist government sought refuge in a much harder EMS. The EMS transformed from 1983 into a disciplinary device whose purpose was to contain the labor question on the basis of disinflation and fiscal restraint. In contrast to France, the UK and US pursued in the early 1980s a policy of austerity. The aim was to disinflate the economy and, importantly, to deregulate entrenched class relations. With monetary policy being tight, working class expectations for wage increases would be moderated by unemployment. Your employers, to prevent the risk of bankruptcy, would have to increase labor productivity, while the readiness of the working class to accept the intensification of this exploitation would be increased due to the threat of redundancy. However, in the early 1980s, the tightening of particularly the dollar led on a global scale to a severe financial crisis. Banks suffered due to a dramatic increase in the company failure. Public deficits soared due to an increase in unemployment, and the decline in tax base and high real interest rates increased the cost of credit. The tightening of monetary policy transformed the credit-based economies of many countries into debtor economies, leading to the so-called debtor crisis of the 1980s and beyond. Against this background, and in the face of potential breakdown of international credit relations, both the UK and US abandoned Friedman's recommendations according to which the control of the money supply will encourage the working class to adjust its aspirations to tight market conditions. Instead, Hayek's version of market freedom became more emphasized. Disinflation was, after 1983, to be achieved by deregulating labor markets directly through an attack on the trade union and through them on the entrenched class positions. The aim was to strengthen the relationship between the money supply and labor productivity through measures such as labor market deregulation, labor process flexibilization, privatization, and the reform of the welfare state towards workfare. These supply-side policies, it was hoped, would adjust the relationship between the money supply and productive work through an increase in the rate of exploitation, leading to greater capital profitability and a renewed period of progressive accumulation of productive capital. At the same time, the financial system that had been dangerously exposed by the emergence of the debtor crisis was refinanced through a huge U.S. budget deficit. This development has variously been described as delinquent or military Keynesianism. In Britain, the attempted disinflation through the control of the money supply was abandoned in 1983. For most of the 1980s, the then Chancellor, Mr. Lawson, sought to enter the British pound into the ERM, much against Thatcher's outspoken opposition. Lawson saw the ERM as a device that would support monetarist policies and enable the government to absolve itself from the impact of tight money. The French government endorsed the ERM for similar reasons. After 1983, France embarked upon a policy of strong French franc to secure and retain competitiveness on the basis of austerity anchored by the German mark through the ERM. By sticking to a harder ERM, monetary policy would be protected from speculative pressure, and the impact of domestic class conflict on monetary policy would be reduced. Ostensibly, austerity would be imposed by Europe, and the social and economic consequences of austerity would be legitimized in terms of international European commitments and requirements. For the German government, the hardening of the EMS was precisely what it had been looking for since the late 1970s. It transformed Western Europe into a DM zone. The EMS subordinated fiscal policy, as well as social and labor market policies, to the objective of price stability and provided a European monetary anchor for the so-called neoliberal supply-side reforms of deregulation. The EMS hardened further after the stock market crash in 1987. Realignment ceased until 1992, when the British pound, which had entered the mechanism in 1990, was forced out of the ERM. The EMS had established the German mark as a European anchor currency, and through the EMS, Germany operated as a European hegemonic power. The EMS was clearly asymmetrical. Member states had to adjust to German conditions. Against German dominance, France sought in the wake of German unification, at the start of the deep recession of the 1990s, to transform the EMS into a more collective system where German economic power and influence would at least have to take account of and be responsive to French interest. France's position was that the power of the German central bank, the Bundesbank, was to be diluted by substituting it with a European central bank. France would thereby gain a policy-making influence over European monetary policy. For Germany, the EMS had worked well, but it accepted EMU to secure French support for German unification. Germany's acceptance of EMU was made easier by the strict and tough convergence criteria for monetary union. The Maastricht Treaty was signed in 1991, yet it was almost blown apart in 1992 and 1993 when the first British and then French, as well as Italy and Spanish, were forced to devalue in the face of speculative pressure and to adopt wider margins of fluctuations against the German mark. Perhaps the single most important factor, which led both to the crisis of the ERM in 1992 to 93, was the continuous and unabated transition to EMU was German unification. Germany tapped the international money markets to finance deficits arising from the cost of unification. This meant that Germany had privileged the international strength of its currency, thereby jettisoning the EMS system in 92 to 93. Yet the appreciation of the German mark not only decreased German export competitiveness, it also brought to the fore the danger of competitive devaluations in Europe. Furthermore, the disruption of the ERM meant that Germany had to face and confront the dollar and the yen without having a secure rear in the form of fixed parities of the EMS. The absence of this secure rear cannot be overestimated in its importance for Germany to accept European monetary union. In short, the strengthening of the Maastricht convergence criteria through the Stability Pact of 1996 reinforced not only German leadership in Europe, it also indicated Bonn's acceptance of the single currency. Germany accepted EMU as an institutional framework which would secure the international drive of German capital. As Halevi comments, German priorities molded with France's surrender to them, Europe's contradictory fiscal stance, and the tight monetary conditions. In conclusion, the breakdown of the system of Bretton Woods, conflict of interest between the US and Europe, and between European countries, especially France and Germany, appears to explain a great deal of the continuous efforts of integrating European monetary relations. However, as the next section will argue, the treatments of the development of European monetary integration through the lens of the strategic interests of member states fails to understand that its principal feature is a containment of class struggle, and that this is the integration of social labor power into the capital relations on the basis of progressive productivity group growth. Of course, each of the European states involved in the creation of EMU has been and continues to be concerned to obtain the most suitable and favorable arrangements to improve their respective competitive positions. There is no doubt that France, for example, seeks a more flexible interpretation of EMU by the ECB to accommodate the kind of labor unrest that for Graul was seen to be capable of delaying the completion of EMU. For Germany, on the other hand, a hard EMU with little flexibility or of interpretation would not only allow it to take advantage of France's troubled labor relations, but also ensure German economic might through its relatively more competitive unit labor cost. A weak euro would mean that Germany readjusts its conditions to those of weaker states, while a strong euro would force weaker states to adjust to German conditions. Besides, a hard euro would support Europe's global aspirations. However, the fundamental question is not what differentiates France and Germany, but rather what unites their efforts. Their unity derives from common class interest. Here, the ruling class of not only France and Germany stand united and have historically been unified. As Anderson comments, since 1983, the attitude of the French elite has been a Vichy-like subservience to German economic power. Moreover, as Carcetti argues convincingly, the euro and thus German leadership is accepted because the bill was paid by labor. At the same time, these policies appear as if they were dictated by quote-unquote Europe in the interest of the quote common good. Furthermore, as Carcetti makes clear, the more the EU controls countries are tied to Germany, the greater the expropriation of value from labor. Why should a domestic bourgeoisie not wish that its working class is made to work harder and faster, and to achieve this in a way which makes it appear as if the bourgeoisie is not responsible for the burden placed on labor? In the EMU, monetary conditions appear to be dictated by Europe and to derive from expert and impartial judgments concerning the best practice of economic regulation. EMU's potential as the management of class conflict is well recognized by Henning. Governments can now credibly argue that their macroeconomic hands are tied and that the burden of adjustment rests mainly with private actors. In short, the conflict of interest between member states is only one of degree. Class in the crisis of capitalist accumulation. Carcetti reports in his contribution that in the early 1990s, more than $1 trillion were looking for a home in the foreign exchange market every day, so that even a slight deviation from the straight and narrow can invite a savaging. This massive amount of money by far exceeds the money required for global commodity transactions and productive investments. Where does all this money capital come from? A capital that appears to increase by investing into itself, M to M prime, dissociating from the progressive exploitation of labor through productive accumulation, M to P to M prime. That is, money to production to money, more money. What is the source of value? Since the late 1960s, credit relations have been checked less and less by the expropriation of value in production. Instead, credit expands to finance in the credit requirements of productive capital in national states at the same time as the rate of profit remains depressed. Credit, then, pertained not in the form of boom lending supporting the progressive accumulation of production capital, but rather maintained company liquidity through the recycling of difficulties. In short, capital, in the form of money, started to apply itself more and more in financial markets, seeking higher and quicker returns than those which could be obtained from the direct investment in the contested terrain of production. This development started in the 1960s. There was the growth of an international financial market which existed outside the official financial system of Bretton Woods and alongside the national regulated markets. Although the new credit markets, the so-called Eurodollar markets, operate outside the regulation mechanisms of the Bretton Woods system, all money in the form of credit existed as a claim on the U.S. gold reserves. Under these circumstances, the system of Bretton Woods was threatened and it was eventually suspended under Nixon between 1971 and 1975. Since then, the dissociation of monetary accumulation from productive accumulation has continued unabated and on an increasing scale, leading to recurring financial and industrial crises, such as, for example, the so-called Asian crises of 1997 to 98. How can one understand this development? Within the limits and context of this discussion, only a brief explanation can be offered. First, the inflationary expansion of credit is an expression of the crisis of containing the productive power of labor within the limits of capitalist profitability. By the 1960s, the capitalist exploitation of labor had led to a situation where the productive power of labor had increased to such an extent that too much capital was produced relative to the capacity of the market to realize, with adequate rates of profit, the surplus value expropriated from labor. At the same time, the exploitation of labor was getting more and more expensive because of higher wage demands, and importantly, because of technological change. The rise in investment required to increase labor productivity increases the cost of production, which even under conditions of a rising rate of exploitation, tends to decrease the rate of profit. This is because of the rising value of constant capital, means of production, relative to variable capital, labor power. As profit fell and as productive investment costs increased, productive capital, on the one hand, borrowed more money to make up for falling profits, so as to overcome difficulties and to invest in new methods of production. On the other hand, earned profits were increasingly placed on money markets, either because of the risk of productive investment or because earned profits were not big enough for instant reconversion into productive investment. Capital was thus suspended from productive accumulation and placed instead in financial markets. This capital was used as credit by productive capital and political authorities to support investment or borrowing requirements. Since the late 1960s, depressed rates of productive accumulation and depression rates of profits had coincided with a rapid monetary accumulation. A growing divorce of monetary accumulation from productive accumulation created a spiral of debt expressed in and over expansion of credit system, speculative runs, bad debt problems, and turbulent financial markets. Second, the disruptive strength of labor made itself felt by the end of the 1960s in resistance to the intensification of exploitation and income policies. In the face of falling rates of profit and readily available credit, governments responded to labor discontent by expansionary policies that fueled inflation and led to budget deficits. In sum, the relation between monetary accumulation and productive accumulation decreased. Furthermore, the contradiction in this development is not only that the increase of rate of monetary accumulation is supported by a relative decline in the productive accumulation of capital, but also the state accumulates deficits that are at the same time guaranteed by the state in its capacity as lender of last resort. In other words, the strength in the relation between the money supply and the productive growth weakened progressively. The dissociation between productive accumulation and monetary accumulation is intensely crisis-ridden. The accumulation of capital in the form of money, M to M prime, is an accumulation of capital that is suspended from the direct exploitation of labor, M to P to M prime. There is thus the contraction between a sluggish exploitation of labor and, therewith, the expropriation of surplus value relative to the accumulation of money. In short, the accumulation of wealth in the form of money is an accumulation of monetary claims on the surplus value not yet extracted from labor. It is a claim, a mortgage on future surplus value. The more money accumulates divorced from productive accumulation, the less it is validated by the expropriation of surplus value, and the more claims on the future exploitation of labor accumulate. The history of the last 25 years suggests that capital found it increasingly difficult to adjust the relationship between monetary accumulation and productive accumulation through a stronger link between money and exploitation. For over a quarter century, economic recessions and monetary turbulences have occurred at regular intervals, and neither has led to a readjustment between productive accumulation and monetary accumulation. If anything, the divorce between them has become more and more emphasized. Paul Maddock, in his analysis of a similar situation in the war period, discussed such a development in terms of a permanent crisis of capitalist accumulation. The credit-sustained reproduction of the capital relations led to a situation where governments were increasingly unable to use inflation as a means of eroding real wages and of devaluing public debt. This is because of the unregulated character of global financial markets, with currency exchange rates floating against each other. The global speculation in the foreign exchange markets asserts itself like an international police force, where speculative pressure on currencies, or indeed a run on currencies, responds to domestic difficulties in containing inflation, through a closer link between working class consumption and productive growth. In other words, the ability of the national state to devalue its debt through inflation is severely restricted through the ability of financial markets to withdraw from such a country by selling its currency. Such a withdrawal or capital flight renders difficult the attraction of internationally mobile money capital required to finance public deficits, including balance of payments deficits. The guarantee of global debt depends on the effective exploitation of labor's productive power. For financial markets, this guarantee translates into the demand that national states pursue credible monetary policies. Furthermore, as noted below, national governments responded to the labor unrest of the late 1960s and early 1970s with expansionary policies. The guarantee of this credit rested on the ability of the national state to guarantee its debt through its role as lender of last resort. An inflationary devaluation of state debt was extremely risky because of the policing power of speculative capital. Again, the disinflation of the money supply and the control of public deficits depended on the ability of the state to adopt restrictive budgetary and monetary policies that redistribute income from the working class to capital. Against this background, the so-called fiscal crisis of the state, the crisis of the welfare state, the shift from a Keynesian legitimating of public policy to the monetarist assertion, you cannot spend what you have not earned, the ascendancy of the notion that the public policy has to be credible, the almost missionary espousal of the politics of austerity, and the new language of economy, efficiency, and effectiveness make sense. They make sense insofar as the containment of the disruptive power of labor, through credit expansion, threatens the ability of national states to guarantee their debt and therewith the international value of their currencies. Besides, as each debtor crisis makes clear, domestic difficulties in guaranteeing the property rights of money capital on the future exploitation of labor are not just domestic, they threaten the global stability of capital's reproduction through the default of debt. A politics of austerity, then, seeks to adjust the burden of debt in relation to the productive accumulation of capital and guarantee the property rights of capital through the control of that part of public expenditure that puts money into the hands of workers. Adjustment is much more than just a technical term which describes the control of public debt. It means a policy of tight money, and thus the replacement of an inflationary response to working class struggle by a policy of state austerity which accepts unemployment as a means for containing inflation. Furthermore, adjustment means the eradication of the balance of payments and deficits through improved exporting earnings. Thus, adjustment amounts to a policy of replacing deficits with sound finance, containing inflation by forging a stronger link between the expansion of the money supply and productive activity. A growth in deficits, which is not matched by productive growth, sooner or later becomes hazardous, leaving investors with only one option, and that is to run. Interest charges will absorb a growing proportion of the national product. In addition, the income from which interest charges have to be paid has already diminished as a result of weak capital formation and sluggish productivity growth in relation to the expansion of credit. In order to adjust consumption to productive work, standards of living have to deteriorate and the efficient use of resources, including labor power and productivity reduction, has to improve. The guarantee, then, of global credit relations, M to M prime, goes forward through a policy of austerity which aims at making workers pay for the repayment of credit through wage restraint, intensification of work, and deteriorating conditions. To adjust the ratio of debt to GDP, the economy has to generate large surpluses that a net transfer of resources pays the interest on accumulated borrowing. Failure to achieve real savings in state expenditure and lower unit labor costs will only exacerbate the burden of debt, and the growing inflationary pressure will lead to speculative currency attacks and drains on the reserves. In short, adjustment entails an attack on the entrenched relations of class power without provoking open class conflict. In response to such conflict, money capital has always fled to more secure, nationally delimited spaces, afraid that the uncertain outcome of such conflict might threaten the wealth it represents. The cumulative effect of such flight is usually called financial turmoil, where a global credit crunch exposes the bad debt exposure of banks and companies alike. In short, financial crisis and industrial crisis belong together as two halves of the same walnut, the crisis of the capitalist exploitation of labor. In short, the adjustment of exploitation to the credit superstructure M to M prime entails not only the risk of company failure, but also the danger of financial turmoil and crisis. A massive industrial crisis means that the very sources that validate money as claims on future surplus value recedes, revealing the bad debt exposure of banks through industrial default. Concerning European monetary integration, the hardening of the EMS from 1983 onwards supplies a supernatural disinflationary anchor that helped to protect national governments from class conflict over bitter long-term adjustment costs. For a government that found it difficult to impose monetary discipline domestically, the ERM offered a golden opportunity to have it implemented from without. The government could be shielded from the unpalatable consequences of economic adjustment by shifting responsibility onto an international regime that supported government's public policy objectives without appearing to be directly responsible for them. There is, of course, no institutional or international fix to the problem of inflation. However, against the background of the global police force speculative capital, government policy has to appear credible so that financial markets maintain confidence in the national containment of the labor question, and so retain trust in the guarantee of security of their investment on the future exploitation of labor. In short, the achievement of counter-inflationary credibility is of utmost importance. European monetary integration emphasizes the issue of credibility, and through it, the guarantee of the property rights of capital on the future exploitation of labor. In sum, national states are not insulated from each other, but subsist in and through the world market. Their capacity to impose austerity upon the working class is policed through speculative capital movements. While governments might have been tempted to inflate the debt away and thereby reduce the burden of debt on many firms as well as eroding real wages and standards of living, speculative runs on currency would have resulted in a liquidity crisis, reinforcing the fiscal crisis of the state and making it more difficult to finance balance of payment deficits. The resolution to the financial crisis is a policy of austerity which aims at reducing the ratio of debt to GDP. However, such a policy is likely to provoke class conflict, leading to sustained speculative attack. Governments are thus keen to ensure the depoliticization of politics austerity through, for example, the replacement of discretionary public policy systems by rules-based systems, including institutional reforms such as central bank independence. Neoliberalism, crisis, and institutional reform. During the 1970s, neoliberal interpretations of the crisis of capitalist accumulation focused entirely, explicitly or implicitly, on the crisis of state authority. These commentaries reacted in a direct manner to the explosiveness of then class conflict and recommended two distinctive solutions. One solution emphasized that the economy was to be freed from political interference to allow the market to self-regulate. This view, which is associated with the liberal economic thoughts of Hayek and Friedman and their critique of Keynesianism, recommended a depoliticization of economic relations. Better, the economy was to recover its quote-unquote autonomy vis-a-vis the political. In contrast to this, the other solution focused more directly on the state and recommended that it should recover its autonomy from society so as to regain its capacity to make decisions. This view is rooted in the theoretical tradition associated not only with Schumpeter, but also Carl Schmitt, the philosopher of German fascism. Within the tradition of economic and political thought, their concerns are connected with the order-liberal tradition of the Freiburg School. This school stresses that the liberty of economic relations should be guaranteed institutionally through a constitutional framework of law, while economic liberalism stresses the self-regulating capacity of unfettered market freedom. Ordoliberalism espoused the idea of an institutionally embedded and constitutionally safeguard economic liberalism. For the economic liberal democracy, combined with Keynesian economic convictions, posed a danger to the very foundations of bourgeois society. For them, the Keynesian state politicized economic relations and undermined market self-regulation, and therewith the relation of liberty. The politicization of economic relations was seen to place a growing burden of demand and expectations on the state. leading to conditions of planned chaos. Politically, then, this view responded to the class conflict by advocating the subordination of social relations to monetary relations to the market. It recommended the dismantling of the welfare state, the undermining of trade unions, and the restoration of relations of economic competition, including the deregulation and flexibilization of the labor market and the labor process. For those advocating the re-autonomization of the state, liberal democracy in an open society involves political parties seeking to outbid each other in their competition for a greater share on the electoral markets. This is seen to lead, on the one hand, to the expansion of inflationary expectations on the part of the electorate, and to political conditions of the ungovernability on the other. Furthermore, for them, the class conflict of the 60s and 70s had led to the democratization of society, and this democratization was seen to pose a serious risk to democracy. In short, the state was seen to become vulnerable to society. As Britain put it, excessive expectations are generated by the democratic aspects of the system, and the temptation to encourage flawed expectations among the electorate becomes overwhelming to politicians. The basic trouble, then, was the lack of a budget constraint among voters. In short, social expectations and demands were seen to have overstretched the welfare state, creating a dependency culture. In addition, social conflicts were no longer confined to the redistribution of wealth, with the trade unions asserting the power of specific social interest against the national interest. There was, then, an inappropriate politicization of the social conflicts that endangered the fabric of society. As King saw it, governments had come to be regarded as a sort of unlimited liability insurance company in the business of insuring all persons at all time against every conceivable risk. In addition, King recognized that the level of non-compliance with the rights of private property had increased. As he put it, the man dependent on his wife to drive him to work finds increasingly that she refuses to do so. Regardless of what King's specific problem might have been, the general thrust of the approach was that the political responses to the class conflict had created conditions of ungovernability characterized by a disparity between the volume of the claims on government sharing out of functions and the government's steering capacity. Both schools of thought then emphasized that the economic consequences of democracy in terms of the decline in the strength of the relationship between consumption and productivity and productive activity. In addition, both stressed that the politicization of social relations had led to conditions of ungovernability and recommended solutions that are distinct only as variants of a common theme. Both agreed that the politicization of the class conflict poses a threat to the bourgeois fragmentations of the political and economic into distinct forms of social organization. In other words, class domination through differentiation of the political and the economic was seen to be at risk, threatening the property rights of capital. The economic liberals argued for the economy to be liberated from the political to allow the market to self-regulate itself and therewith to safeguard the subordination of social relations to the market. Those emphasizing the crisis of the state recommended the autonomization of the political from society to secure the decision-making power of the state over society. Both, in other words, and in their own way, recommend the re-autonomization of the economic and the political from each other, reinforcing and securing their bourgeois fragmentation. For the economic liberals, this was to be achieved by rolling back the state, reconstituting the freedom of the market relations. For others, it was to be achieved by rolling back the state from society through institutional reform. The difference, then, between the two solutions is one of degrees. Both stress the need for depoliticization of economic relations and the depoliticization of political relations. Both attempts at rolling back depend on the depoliticization of class conflict, and that is on the fragmentation of class into an economic factor of production on the one hand and a law-abiding citizen on the other. Only on this basis would society again be able to cherish the liberating potential of hard labor. The order-liberal solution goes much deeper than the dogmatic call for market self-regulation on the part of the market liberals. The order-liberal suggestions include not only the promotion of value, such as self-restraint and discipline, but also the re-autonomization of the state from society. That is, the removal of decision-making from mass democratic influence. The real target of reform was the power of the working class to compel government to commit concessions such as welfare guarantees. In short, discretionary processes of decision-making were to be replaced by rules-based systems. Institutional restructuring, then, was to re-autonomize the most vital aspect of the state by transferring them into one extra democratic domains. During the 70s, the focus of re-autonomization fell concerning the German political agenda on the Constitutional Court, and also the Bundesbank within the context of the EMU. The issue of the independence and autonomy of the ECB was very much emphasized. As Emerson sees it, a stable and credible monetary regime requires an independent central bank with the statutory mandate to guarantee price stability. Otherwise, the public might expect that the authorities might be tempted to use surprise inflation to temporarily increase output or temporarily reduce the real interest rates on public debt. Despite splitting his infinitives, Emerson merely confirms that a democratic society and relations of exploitation are incompatible. The guiding idea for institutional reorganization is that there are, in a market economy, basic values that stand over and above the expectations and aspirations of the majority. That is, the dependent masses, in other words, all those who depend for their existence on selling their labor power. Thus, the institutional restructuring of the state was intended to reaffirm the limited character of the liberal democratic principle of majority rule. The basic value of liberal democracy, those connected with the rights to private property, constitute the social basis upon which liberal democracy's power of decision-making rests. Liberal democracy is charged with protecting and safeguarding the rights and values of bourgeois society through law and order. Liberal democratic lawmaking is thus confined to the rule of abstract equality, freedom, property, and bentham, i.e. the constitutional rights of capital. In other words, the order-liberal proposal for institutional reform sought to assert these constitutional rights by insulating them from working-class aspirations and demands. In the context of this discussion, the purpose of institutional restructuring was to depoliticize monetary policy by removing it from the contested terrain of class conflict. Central bank independence, in this way, would provide a framework within the social conflict to take place without, however, posing a risk to the conduct of monetary policy. For its advocates, institutional reform would reduce the vulnerability of the state to mass democratic aspirations and moderate the capacity of the working class to demand improved conditions. The neoliberal view of the crisis of the authority of the state was based on the conviction that the mob had entered government. Similar views had been aired during the crisis of the interwar period during the beginning of the last century. Bernard Baruch, a leading Democrat, had protested against Roosevelt's decision to abandon the gold standard in 1933 by saying that it can't be defended except as mob rule. Maybe the country doesn't know it yet, but I think we've been in a revolution more drastic than the French Revolution. The crowd has seized to seize a government and is trying to seize the wealth. Respect for law and order is gone. For Baruch, correctly, the dependent masses are the majority, and the liberal democratic system needs to defend itself against the majority through, for example, extra democratic decision-making powers, particularly in the field of monetary policy, so as to preserve and guarantee the existence of bourgeois property rights. In this context, the work of Carl Schmitt provides useful insights. He perceived the crisis of the interwar period in terms of a decomposition of social and political, as well as cultural structures. This decomposition was seen to be a consequence of the emergence of mass society and caused by the influence that it was able to exert on the structure of the political. Institutionally, parliamentary democracy for Schmitt caused and focused on the crisis. The political was subjected, on one hand, to pluralist demands, and on the other, to class-specific interests, social equality, and emancipation. In short, Schmitt emphasized that the parliamentary system undermined the ability of the state to make decisions because society had transformed the political into an expression of distinct social interests, leading to the fragmentation of the political, and therewith the decomposition of the central institution that for Schmitt is able to maintain social harmony. The state was thus seen to have become socialized, and the class-divided nature of society was seen to be produced within the political. The socialization of the state then undermined the central and principal institution capable of making decisions. Hence Schmitt's call for the restoration of the political of the state emphasized from the state had to liberate itself from society, and that this liberation had to be based on the elimination of all forms of social conflict. Conflict, that is, which is not authorized and conducted by the state. Only in this basis would the national interest and common values be secured and guaranteed. In other words, the working class was not only asked to obey the rule of law and through it the management of its labor power, but also to love it. Schmidt's notion of the autonomy of the political outlived its importance, fascism. This is not because the economy and the state, the political, are two distinct entities of human organization. Rather, the bourgeois state's historic role of protecting the law of private property entailed the state as a bourgeois form of the social organization of exploitation. Yet, as such a form, it appears to stand outside social relations as an institution in its own right, whose distinct purpose is to safeguard, through law, the proper conduct of equal and free exchange relations between property owners. Hence, the attempt of political theory to construe the state as a distinct form of political organization that resides outside social relations and that merely intervenes from the outside into society to secure and guarantee the foundations upon which the society of burghers rest, the rights of private property. What makes the 1970s debate on ungovernability and institutional reform significant is its conceptualization of the autonomy of the political against the background of intense class conflict. The proponents of ungovernability perceive the democratization of society, or as they put it, the permissive society, as a threat to the ability of the state to secure the relations of economic liberty and recommend institutional reforms to depoliticize, for example, monetary policy. In conclusion, the advocates of market liberalism argue for the autonomy of the economic from the state, and the proponents of the state reform argue for the autonomization of the state from society. Of course, the two proposals overlap. Friedman's notion that the political authorities should conduct monetary policy independent from specific social interest, that is, working class interest, and that these interests would automatically accommodate their bargaining behavior to restrictive monetary policy, shows the overlap well. However, in our context, Hayek is much more important. In the 1930s, he advocated that the national states should combine to create a federal state system. Such an arrangement was endorsed as preventing inflationary demands, which, for him, were a consequence of the polarization of class relations within independent national states. The establishment of a supranational political framework was endorsed as a means that would encourage competitiveness against national politics of economic protectionism, support for depoliticization of economic relations against the power of special interest, the working class, to subject the national state to a politics of inflationary demand management and do away with restriction on the movement of capital, labor, and commodities. Furthermore, supranationalism would narrow the scope for the regulation of economic life, discourage the solidarity of the working class through its national fragmentation, and render possible the creation of common rules of law, a uniform monetary system, and common control of communications. Supranationalism was thus endorsed as a way of keeping the state out of economic concerns. Better, it was endorsed as a device that would disempower the working class to force governments to moderate its aspirations through welfare and employment guarantees. The power of the mob to distort the relations of liberty would thus be severely restricted, allowing the state to administer justice impartially and in tranquility. Supranational, then, was espoused as providing a rational framework within which individual initiatives will have the largest possible scope. Nothing would stand in the way to what today is termed the deregulation and flexibilization of the wage relations. As Hayek saw it, even such legislation as the restriction of child labor or of working hours becomes difficult to carry out for the individual state. He accorded particular attention to the circumstance that within a supranational union, individual states will not be able to pursue an independent monetary policy. In his view, national governments cannot always be trusted with monetary policy, even if they are committed to a policy of price stability. Politicians, he seemed to suggest, are always governing with the next election in mind, perverting even the committed monetarists to give in to popular pressure and lead to a politics of compromise and therewith an integration of the working class into the capital relation on the basis of material concessions. Furthermore, monetary policy always requires an element of judgment and thus discretion that the government might abuse to retain popularity. A supranational operation of monetarist policy with an independent bank removed from the domestic considerations would thus create a space for making of monetary policy that is rule-based and therewith protected from the distorting influence of working class demands. The removal, then, of the central bank from political influence would accord it to a quasi-judicial status, independent from the established system of democratic government, undermining a Keynesian politics of class compromise at the national level. In short, a domestic policy of austerity would be anchored into a supranational regime. Hayek's endorsement of supranationalism appears to support the former British Chancellor, Mr. Lawson, who argued during the 1980s against Thatcher in favor of British entry into the ERM. However, by the 1970s, Hayek had changed his position. He argued against his supranational proposals for market freedom and in favor of the denationalization of and competition between currencies. His rejection of supranationalism might well have to do with his distrust of what today, in relation to the EU, is called subsidiarity. In fact, when advocating supranationalism, Hayek provides useful insights into the political economy of subsidiarity by making a strong distinction between those institutions responsible for monetary policy and fiscal policy, with fiscal policy a national responsibility and monetary policy a supranational task. His rejection, then, in the 1970s of supranationalism appears to have been caused by his fear that subsidiarity might develop into a paper tiger, with the supranational institutions taking responsibility for fiscal policy, leading to an inflation-prone signal currency and a supranational system of redistribution associated with Keynesianism. This section has argued that the neoliberal debate in the 1970s on the crisis of the state was directly concerned with the then class conflict, and that the remedies he suggested provide useful insights into the politics of EMU. The debate endorsed the institutional autonomization of the state from society as a means of subordinating the disruptive under the obligation of the responsibility. This would secure not only compliance with the law on the part of the citizen, but also ensure that the law-abiding citizenry constitutes, by virtue of its behavior, a reliable and flexible human factor of production. As Emerson explains in relation to the EMU, since in democratic societies, elected officials are in general free to determine economic policy at their discretion, it is very difficult for political bodies to acquire enough credibility to create surprise inflation. EMU, in this view, is a device to exclude the mob from the scat of government. The politics of the European Monetary Union. Introduction. Most commentators on the EMU raise the importance of the connection between the global instability of capitalist reproduction and the domestic containment of the labor question. For example, Gross and Thygesen report that the accord between France and Germany in the late 1970s on the creation of the EMS considered the strengthening of the domestic conditions to be of utmost importance. The then German Chancellor, Mr. Schmidt, appeared to have been particularly concerned over the dangerous political developments in Italy, where the Italian bourgeoisie sought to contain the class conflict by co-opting the Communist Party into positions of government. For Schmidt, the EMS would stabilize economic relations and provide a European framework that would legitimize austerity. During the 1980s, Mr. Lawson, the then British Chancellor, while not facing the indignity of having to respond to class conflict by co-opting the British left into positions of political responsibility, argued for British membership in the ERM for almost the same reason. A politics of price stability would be institutionally fixed at the same time as the British government would be able to hide behind the ERM, absolving itself from the consequences of tight money. The EMU goes much further than the EMS by substituting national currencies with a single one, the euro. Proponents of the EMU argue that it is a nationally neutral device in contrast to the EMS, which is seen to have been asymmetrically supporting German hegemony in Europe. For Pato Schioppa, EMU is based on a collective decision-making mechanism which undercuts national hegemony across Europe, in favor of a collective hegemon, or as he puts it, a collective prince. His Machiavellian conception of the EMU is apt. As he explains, the single currency will involve a union based on the transfer to a community institution of the money political power that are currently exercised by the national central banks. For him, the personification of the Machiavellian prince is the European Central Bank. Expanding on his metaphor, who is courting the prince and who is the fourth estate? In the European Monetary Union, member states lose the possibility of devaluation, and the possibility of revaluation at the center will cease to exist as an option when and if full EMU is achieved. Thus, while EMU is concerning its form, indeed symmetrical, the fact that the strong are usually reluctant to revalue while the weaker are often forced into devaluation gives the game away. The trajectory of the former GDR since German unification appears to hold the mirror image of what might happen in those European countries that find it difficult to compete with German levels of productivity. However, in distinction to German unification, where the new East German Länder receive enormous fiscal transfers, EMU specifically excludes fiscal transfers from the center to troubled national states, while the resources of the region have been and are expected to remain limited. Furthermore, EMU's severity limits the fiscal power of the member states. While they maintain a formal responsibility for fiscal policy, member states will have to show fiscal rectitude to avoid punishment. As Godley sees it, if a country or region has no power to devalue, and if it's not the beneficiary of a system of fiscal equalization, then there is nothing to stop it suffering a process of cultivative and terminal decline, leading in the end to immigration as the only alternative to poverty and starvation. While its assessment is one of the likely consequences of EMU, rightly emphasizes the potentially devastating impact of the monetary union on less competitive countries, it remains nevertheless blinkered. It presumes some sort of national interest on the part of the national people, with Germany dictating terms through EMU. What, however, is Germany? Does the notion of Germany imply that the German unemployed are dictating? Will the German working class, as indeed it does, not also face pressure to work harder in the face of worsening conditions? There is, however, no doubt that Germany dictates, and it does so through its on average more competitive unit labor costs. In other words, Germany's dominant position in Europe is based on the relatively more effective exploitation of labor within its territory. The economic advantage impresses itself upon the working classes of other member states who, in order to remain employed, are forced to adjust to German rates of exploitation. With EMU, the currency exchange rate instrument is no longer available as a means of adjusting sluggish competitiveness to global conditions through currency devaluations. Failure by employers to respond to tight monetary conditions through improvements in the exploitation of labor might well lead to losses of competitiveness and bankruptcy. In other words, a policy of tight money forces employers to adjust to exploitation of labor might as well lead to a loss of competitiveness and bankruptcy. In other words, a policy of tight money forces employers to adjust the exploitation of labor to globally competitive standards. The labor policies that EMU encourages and anchors institutionally are those wanted by national governments and capital. And EMU disguises these as if it were an economic policy imposed by some distant bureaucracy for which the member states are not responsible, in reflecting some socially neutral rationality. In other words, with the EMU, class politics is disguised in the language of European integration. In this way, and as Anderson argues succinctly, the European bourgeoisie is ready to accept EMU as long as the cost adjustment falls on labor, and as long as the EMU makes it appear as if it's not responsible for the burden placed on labor. In short, for them, government through EMU, and therefore with resourceful exploitation of labor in Germany, is by far more acceptable than the prospect of being subjected to working class demands for improved conditions, or indeed revolutionary demands for the transformation of the means of production into the means of emancipation. In sum, Paris Choppy endorses EMU as a collective prince is apt both in terms of the collective interests of the European bourgeoisie and in terms of the centralization of monetary policy at the European level. The name of the prince is austerity, and the purpose of the prince is the depolitization of monetary policy, and the aim of the prince is the achievement of greater expropriation of value from labor. In EMU, labor market and wealth policy remain within the realm the remit of national governments. Member states will retain distributive options on necessarily reduced expenditure within balanced budgets, and according to Union fiscal recommendations, the subsidiarity principle of EMU is hierarchically structured, with monetary policy at the supranational level, fiscal policy at the intermediate level, and labor market policies of deregulation, flexibility, and privatization at the national level. With this troika, the supranational level of monetary policy is decisive. EMU renounces the competitive instruments of poor countries, inflation and devaluation. It calls industrial capital a task, and thus is functional for the greater creation of surplus value, rather than simply for a more favorable redistribution of the surplus value created. Whether it will be functional remains, of course, to be seen. Nevertheless, EMU makes clear that employers will have to improve competitiveness on the basis of lower labor unit cost, and that it is through the intensification of the exploitation of labor's productive power. Failure to exploit labor more effectively will carry the risk of competitive erosion and bankruptcy. The European Central Bank. The sole task of the ECB is to guarantee price stability. The objective of EMU is to achieve sound money, and the achievement of this objective is seen to be a credibility problem. One way to bolster the credibility of this objective is to assign the responsibility for monetary policy to an institution that is not subjected to political influence. An independent ECB, then, is endorsed as an institutional device that will ostensibly take politics out of economics, reinforcing the view that politics and economics are not only distinct forms of social organization, but also that the making of monetary policy is in fact a non-political thing. Moreover, the institutional design of EMU reinforces the view that the economy, if left to its own devices, is self-regulating, and that the institution of the market is a class-neutral, socially impartial institution whose sole criteria are efficiency, economy, and effectiveness. The ECB then is endorsed as an impartial institution whose decisions depend on technical expertise and the rational regulation of economic mechanisms. Thus, by removing the making of monetary policy as far as possible from the contested terrain of class conflict, it is expected that the politics of austerity will be protected from the mob, as the proponents of EMU make clear. Expectations are at the heart of the inflation process. Since according to its advocates, inflation is caused by expectations, and since economic relations are self-regulating, and since national governments are no longer responsible for monetary policy, any economic failure under EMU would reflect a lack of accommodations on the part of the human factor of production to the limits of the market or the unreasonableness of actors who get a wage. In EMU, the central bank cannot be given instruments by any democratic body, as if it were a court of law rather than an instrument of public policy. The ECB, following Graal, is specifically excluded from lending directly to government at EMU and national levels, and is obligated to avoid the monetary finance of public sector deficits. The ECB is not involved in any way in the financial position of the member states, because financial markets must be convinced that neither the central bank nor any other community institution is implicitly guarantees the obligation of national governments. In conclusion, the ECB is institutionally divorced from national concerns and unaccountable to democratic majorities. Its institutional constitution is so structured as to make monetary policy appear as a non-political process, and so conceived as to insulate national governments from popular pressure. At the same time, national governments are empowered to argue that they can do no other than pursue a politics of austerity. Their hands are ostensibly tied by the decisions of the ECB. In short, what governments did not dare to implement, or indeed failed to pursue on their own because of opposition, is now imposed upon them, and this is on their own will and initiative. The proponents of EMU do of course recognize that class conflict might lead to tensions on labor, market, and excessive wage increases. Would the ECB, in spite of its statutory duty, accommodate to inflationary wage pressure, or would it maintain price stability? Thus, class conflict might threaten to the legitimacy of the European project. For this reason, it is argued that the politics of the ECB has to be legitimized through a degree of democratic compatibility. As Emerson sees it, regular reports to the European Parliament might therefore actually facilitate the task of the ECB, provides a more detailed account on the democratic legitimation of the ECB. Padoa Schioppa provides a more detailed account of the democratic legitimation of the ECB. Yet longer, though the account may be, Emerson's much briefer version of it is at least less embarrassing. Okay. Nonetheless, the issue raised by the problem of the democratic legitimacy of monetary union is of course most important regarding the politics of class. In this context, the principle of subsidiarity is of importance. While the central aspects of EMU, monetary policy is located at the supranational level. Fiscal policy, while restricted and subjected to supranational surveillance and coordination, is given some degree of flexibility to cope with local shocks. The most decentralized aspect of subsidiarity concerns the retention of labor market policies and welfare policies by the member states. This arrangement retains and offers to labor the national territory as the framework for working-class conflict. The idea, it seems, is that monetary supranational integration, fiscal coordination, and national responsibility for labor will reinforce the national territorialization and regimentation of the working class, so protecting monetary policy from sustained class conflict. A territorialization of the European working class would of course be helpful for fragmenting its resistance to austerity across Europe. It would be useful for addressing the requirement for higher labor productivity in terms of the national interests, and it would be supportive to containing discontent with declining conditions on the basis of nationalist sentiment. Whether EMU will be functional in this way is of course a different question, and will be discussed in the conclusion section. Fiscal policy. The European Monetary Union is robust about the needs for fiscal austerity as a corollary of and condition for the stability of monetary union. However, in EMU, the ability of national governments to respond to labor conflict through fiscal expansionism is both restricted and increased. It is increased because, as Garrett reports, EMU proposes a strong incentive for member states to free ride on the union running large budget deficits. There is thus the danger that national fiscal expansionism might pose a major threat to the overall monetary stability of the Union. In addition, the cost of deficit financing would be shifted on to participating countries. The crucial question then for the question then for the stability of EMU is that of fiscal policy, and through it of containing class conflict within the permitted public expenditure levels across the EU. As Padoa Schioppa puts it, the question is whether monetary union runs a risk, then, is one of moral hazard. Should a member state that responds to class conflict with fiscal profligacy be stabilized by fiscal transfers from other member countries, or should ECB, despite its brief not to do so, be allowed to monetize the accrued national debt? Were such responses legitimate? Would this not invite member states to adopt unsustainable both fiscal measures to cushion social conflicts? An important aspect of the debate on EMU focuses on the creation of safeguards to ensure that fiscal profligacy is rendered impossible. Germany favors a hard EMU with no obligations to stabilize or refinance, for example. Italy, through fiscal transfer, France in favor of labor unrest seeks a more flexible interpretation of Maastricht to allow scope for dealing with social discontent. Besides a more flexible arrangement, and therewith a softer euro, would of course mean that Germany would adjust the conditions of labor productivity pertaining in France. However, a softer euro is anathema not only to Germany, because softening would question the firmness of monetary union derailing and the politics of tight money domestically. Such derailment would have serious consequences at a global level. In short, EMU inscribes in money in institutional form what capital and its national states have sought in vain over the last 2 decades. National governments use, as Grau puts it, Maastricht as an alibi for their own projects of establishing more restrictive welfare regimes to intensify market discipline in the favor of particular social strata. The differences, then, between the French and German conceptions are distinct only as variants of a common theme, and that is that monetary unions need to be buttressed with fiscal restraint. In EMU, fiscal policy is to support monetary union and not to weaken the value of the euro through the so-called fiscal expansionism that is associated with Keynesianism. In EMU, fiscal policy resides formally with the member states. At the same time, the Union has the power of coordination and surveillance, and the ability to recommend modifications of fiscal policy and to apply sanctions against government that have not taken the recommended steps. In short, the Union has the power to enforce fiscal discipline upon member states. A different solution to the ability of member states to adopt expansionary responses to class conflict would have been the transfer of fiscal responsibility to the Union. This would have led, constitutionally, to just that sort of fiscal federalism that Hayek, and with him the proponents of EMU, feared. However, in EMU, subsidiarity, not the Leviathan, is the catchword for European political union. Yet subsidiarity might be the catchword, the content of the fiscal policy arrangement is clearly the loss of fiscal demand management as a means of containing labor conflicts in member states. EMU is seen to require safeguards against unsustainable budgetary policies in a member state because these are seen to lead to either default or debt monetization, which would be a major threat to the overall monetary stability. In this view, and indeed as the convergence criteria of Maastricht makes clear, any resident debt, whatever the objection of the expenditure, is unsustainable. As Emerson put it, fiscal discipline is defined as the avoidance of an unsustainable buildup of public debt, and the transition to EMU amplifies the domestic effectiveness of national fiscal policy for stabilization purposes, requiring a tight control of member states if fiscal expansion were systematically beggar thy neighbor in character. In short, surveillance will have to correct possible tendencies for budget deficits to become too large, and EMU relies on fiscal policy to reduce budget deficits. The EMU then seeks to render obsolete anti-cyclical fiscal policies associated with Keynesianism and confers on fiscal policy the task of controlling public expenditure. EMU discourages a politics of fiscal equalization from rich to poor member countries. Any fiscal demand management, as the proponent of EMU sees it, involves the risk of weakening incentives for production activity and creates stable welfare dependency. Thus, member states are encouraged to modernize their economy through privatization, deregulation of labor markets, flexibilization of labor processes, and the like, including the containment of welfare, state expenditure, despite high levels of redundant labor. After all, as one of the members of the Inner Circle of New Labour put it, high unemployment is linked to generous benefits that run on indefinitely, and to the poor educational standard at the lowest end of the labor market. The proponents of EMU endorse it as a framework of incentive and constraints that will condition national budgetary policies, for which the key words will be autonomy, which means to respond to country-specific problems, discipline, to avoid excessive deficits, and coordination, to assure an appropriate overall policy mix in the community. In sum, the retention of fiscal powers by national states is to an extent merely formal at the same time as the Union has no fiscal responsibilities. Its task is to make sure that member states pursue a politics of fiscal restraint. The Union then has the power to discipline fiscally lax member states, while member states retain the power to implement a responsible fiscal policy by virtue of their own political sovereignty. Subsidiarity then means that the Union decides on what is fiscally permissible, while member states retain the power to adopt a responsible fiscal policy that redistributes income from labor to capital. Thus, EMU does explicitly reject fiscal federalism. It merely empowers the Union to police the fiscal stance of its members. This then creates a problem for the reformist labor movement in that neither the national government nor the Union appear responsible for fiscal policy, yet the complete loss of the possible of exchange rate adjustment by the member states raises the issue of fiscal policy as a supranational concern. However, the existing structure of EMU makes clear that fiscal policy is not available as a supranational policy instrument. This seems to imply, as Eichengreen argues, that with neither fiscal nor monetary flexibility, Europe will be helpless in the face of business cycle disturbance. This might well be so useless, of course, unless adjustment and flexibility is derived from European labor improving its productivity in relation to global competition levels. For its proponents, EMU means that the working class can no longer expect concessions such as extensive and generous welfare support mechanisms. EMU is seen to provide strong incentives for labor to move from areas of unemployment to those where employment might be gained. Increased competition within the EU might also result in an increased responsiveness of wages to unemployment, with labor market flexibility, and most importantly, wage flexibility. The most important adjustment instrument. Yet, as Emerson et al. And others recognize, such adjustment on the part of the working class, that is, its utility as an economic, effective, and efficient human resource, might take time. For this reason, the retention of fiscal policy by national states is endorsed as a means of enabling national states to respond to local shocks in order to achieve short-term stabilization for the purpose of medium-term adjustment. However, while national governments may use fiscal policy measures to absorb local shocks, these have to be coordinated with other member countries. Importantly, the fiscal responsibility of shocks is to ensure the maintenance of price stability and wage discipline. As Emerson sees it, the purpose and aim of fiscal policy is to offset increases in domestic demand because price and wage adjustments take time due to a lack of wage discipline on the part of the working class. The aim and purpose, then, of national fiscal policy is to induce real wage adjustments. The stability of EMU depends, then, on the readiness of European labor to support the achievement of price stability across Europe through a much more productive utilization of her productive power. Adjustment in labor. Advocates of EMU see it as a device that will readjust monetary accumulation to productive accumulation on the basis of a stronger link between working class consumption and productivity growth. The convergence criteria and stability pacts subordinate countries with relatively high unit labor costs much more directly to those with low unit labor costs. With national currency devaluation rendered obsolete and fiscal policy disciplined by EMU, the wage price flexibility remains the basic adjustment channel as a substitute for the nominal exchange rate. In addition, labor migration is expected to adjust the burden of unemployment on national budgets. In short, EMU focuses adjustment on two primary channels. A. Workers can move. B. Workers can change. EMU focuses on the policy of deregulation, flexibilization, wage discipline, labor mobility, and particular lower unit labor costs as the basis through which European economies will have to adjust. Lower labor costs are a condition to the relative price decreases needed to restore the competitive position of member states and to bring output and employment back into equilibrium and factor mobility, in particular labor mobility, may solve the problem through migration. The belief is that wage bargainers will be affected by a credible monetary union as they will realize that excessive wage rises will not be underwritten by devaluations. In other words, the cost in terms of output and employment might not be high if the working class submits to wage restraint, and if it is willing to let itself be exploited more effectively, efficient, and economically. Advocates of EMU project the mobility of U.S. labor as the future of European labor. European labor mobility is seen as one of the most important stabilizers of EMU, yet where should labor go, and what happens if she wishes to stay? In sum, the politics of subsidiarity envisages that the institutionalization of price stability as a supranational level will support national governments if in their efforts to achieve a full-scale marketization of the factor labor and force employers to maintain competitiveness by confronting the working class in the contested terrain of production to increase labor productivity. This is not to say that employers have not confronted their workers in the past, yet with the devaluation of exchange rates rendered obsolete, and with the ECB seeking price stability at the European level, divorced from the national concerns, the room for compromise towards the concessions of to labor have decreased significantly, just as the Hayek of the 1930s thought it would. As Henning puts it, knowing that exchange rate policy vis-a-vis other members of the Union can no longer reverse the deleterious effects on competitiveness of high wage and price increases, firms and unions should act with greater discipline. EMU, then, is seen to spur employers and union onto the greatest efforts to achieve lower unit labor cost, while EMU amounts to an attempt at making the European working class pay for the containment of inflation and the control of deficits. It appears at the same time as a merely technical device, and importantly, as a realization of European harmony replaces its long history of bloody war and conquest. EMU, it seems, seeks to justify the intensification of exploitation and the deterioration of conditions through the absence of war. In EMU, the definition of monetary policy as a merely technical device, best left to the experts in the elevation of monetary policy to the supranational level, seems to indicate Padova Schioppa's view of EMU as resembling a modern version of Machiavelli's Prince. Its core is fiscal policy that is located in the twilight zone between the national state and the Union. The subject of the prince are the European working classes, who are territorially regimented in the fiefdoms of their national states. As a citizen of the human factor of production, appearances in EMU designs in the form that have been visited upon the dependent masses since Roman times. It appears as the plebes. The metaphor of the prince, then, entails the transformation of the national boat into the European home. The majority rowing, the minority navigating, yet as is argued, the EMU needs to be seen against the background of the crisis of the overaccumulation of capital since the late 1960s. Since then, capital and its national states have failed to reintegrate labor into the capital relation as an effective factor of production whose exploitation guarantees the global credit superstructure in the present and whose consumption is within the limits of productivity growth. EMC has not caused the deep recession of the 1990s, nor has it forced governments to deflate their economies. DAU provides an institutional framework for cooperating with the labor question through the institutionalization of a deflationary regime that imposes on their own initiatives upon national governments a policy they either failed or did not dare to implement due to fear of labor unrest. There is, however, neither institutional fix to the problem of inflation, nor an institutional solution to the labor question. Class struggle has to be fought, and of course the institutional reorganization of political power at the European level is an important aspect of this fight. However, as the conclusion argues, such a reorganization reproduces the contradiction it ostensibly sets to resolve. Conclusion. The chapter has argued that EMU is politically motivated and that it is much response to domestic as to global conditions. Both of these conditions are intrinsically linked, and in and through the capitalist crisis of exploiting labor on an expanding scale, since the late 1960s, the growth rate of monetary accumulation has outstripped those of productive accumulation. Monetary accumulation, dissociated from the productive accumulation, presents the claim on surplus value still to be expropriated from labor. As a consequence, the strength of the relationship between money and exploitation declines on a global scale. Instead, the claims on the future exploitation of labor accumulated and strengthened the relationship between consumption and productivity growth weakened. Moreover, national states lost the ability to erode real wages through inflation because of the speculative threat to currency exchange rates. In this context, the search for counter-inflationary credibility is of paramount importance. Counter-inflationary credibility, however, is not just a sort of technical thing. It involves the containment of class conflict on the basis of austerity that seeks to strengthen the link between consumption and labor productivity. In short, a politics of austerity means a prolonged period of not only living on less, but also of worlding harder, longer, and more intensely, and more flexibly in the face of declining conditions. Against this background of convergence criteria of EMC and the Stability Pact makes revealing reading. They institutionalized a politics of austerity by calling for a stronger relationship between consumption and labor productivity through the control of monetary policy, or austerity. Fiscal restraint, the control of budgets, and the loss of exchange rate devaluations as means of adjustment, sluggish domestic competitiveness to the international conditions. However, while focusing adjustments on the working class, governments have to be careful not to provoke sustained class conflict to avoid uncertainty and thus to maintain credibility. The attempt, then, at depoliticizing the making of monetary policy is of vital importance. The neoliberal recommendation for overcoming the crisis of state focused precisely on this issue. EMU amounts, then, to an institutional attempt at buttressing domestic policies of austerity with a supernatural anchor. Supranational. Institutionally, social and labor market policies remain national in nature, allowing for the labor movement to be fragmented rather than integrated on a pan-European basis. The EMU provides an institutional framework for a comprehensive restructuring of labor relations and erodes the conditions of existence of the welfare national state. Most importantly, it creates a huge integrated market where countries with low productivity rates relative to the major economic powers in the EU will face intensely competitive pressure. It has been argued that the European bourgeoisie is supportive of the EMU because the burden of adjustment is carried by labor, and it has been suggested that the EMU is so structured as to depoliticize the making of monetary policy and to insulate monetary policy from working class demands. EMU then appears to amount to the institutionalization of anti-inflationary policies that police force that seeks to protect member states from speculative runs by securing the rights of private property internally. Furthermore, EMU not only seeks to depoliticize the attack on the labor movement, but also to reinforce and exploit its regional and national fragmentation. Hayek in the 1930s advocated supranationalism for this very reason. For him, interstate federalism would dilute class polarization, decompose entrenched positions of class power, and depoliticize the class struggle. Instead, there would emerge complex and changing relations of conflict between the classes. For Hayek, class conflict would be replaced by competitive pluralist relations, segmenting working class struggles, and disempowering sustained resistance to the politics of money at the center. EMU, it has been argued, is an institutional arrangement designed to insulate key economic agencies, especially central banks, from interference by elected politicians. In qualification to Gill, the most intriguing aspect of EMU is not the insulation of key economic agencies from political interference, but rather the institutional assertion that the political and economic are two distinct forms of social organization. Central bank monetary policy is directly political in nature, and EMU's efforts to make it look unpolitical present the most important aspects of the depoliticization of the politics of class. Furthermore, it would be quite wrong to suggest that before EMU, there had been democratic control over monetary policy, conferring influence over its conduct on labor-related movements. With EMU, the concentration of unaccountable decision-making lies precisely in those areas where the capitalist nation-state itself has always resisted democratic encroachment, most trenchantly: monetary policy. The supranational character of EMU, then, is important not because it makes democratic unaccountability, what previously had been democratically accountable. The importance is rather that national states, on their own initiative, will no longer be able to accommodate class conflict with credit expansion or currency devaluation. Instead, EMU places binding constraints on state power, institutionalizing a supranational anchor for the subordination of labor to the discipline of the market. EMU then amounts to an arrangement that preemptively undercuts expansionary responses to labor conflict and unrest. Maastricht, following Anderson, leads to an obliteration of what is left of the Keynesian legacy that Hayek deplored, and most of the distinctive grains of the Western European labor movement associated with it. Maastricht then inscribes into the EU the neoliberal policy of market freedom associated with Hayek, and it does so through creating a constitutional device associated with ordoliberalism. However, despite appearances to the contrary, the European Monetary Union, rather than providing an institutional fix to the labor question, might, I would suggest, amplify and transmit regional class conflicts across the EU. What would happen if a member state fails to contain class conflict on the basis of fiscal restraint and would be compelled to adopt fiscal expansionism instead? What power or sanction would the EU have? Suspending the membership of such a state in the EMU would undermine EMU. Refinancing the member state would reinforce the threat of monetary instability across Europe, just in the same way as unsustainable national levels of public debt jeopardize the objective of tight money on a European scale. Should the EU be empowered to call for the resignation of the national government that failed in its task to guarantee the citizenship rights of private property? Of course, the member state cannot simply replace its discontent with working class or more docile one. What effect, then, would sustained working class struggle have on EMU? In the absence of macroeconomic instruments of accommodating working class resistance to austerity and intensification of exploitation through inflation, currency, devaluation, and fiscal redistribution, how to protect European monetary relations other than by coercive means, and on whose orders? In short, Minford is not too far off the mark when he says that when the goings get rough, someone has to stop people running for the door, and only a state has that power. What is the state's name that possesses, in the Schmittian perspective, the sovereignty to declare an emergency so that we all follow the lead of the invisible hand and behave well as mere personifications of the capital's exchange relations? This scenario might sound bizarre, yet Hayek's abandonment of his earlier endorsements of supranationalism is not without significance for the understanding of working class power in EMU. The European bourgeoisie is, as was argued, united in EMU for as long as the labor carries the burden. Whether the working class, however territorial fragmented, will carry the burden is quite a different matter. Would, for example, the European bourgeoisie agree to pay the cost for containing class conflict in, for example, Italy through fiscal transfers, stabilizing EMU through fiscal expansionism, and therewith in inflationary devaluation of its wealth in a weaker euro? Besides concerning Germany, despite huge fiscal transfers to the former GDR, East Germany still remains one of the poorest regions in the EU. Would the European bourgeoisie wish to see a transfer of resources to the south of Italy to destabilize relations without making a profit? Surely such a transfer might well sustain a certain level of consumption without, however, leading to an increase in productive activity. Or should South Italian labor be invited to migrate to more prosperous areas where its skills are in low demand? Or should the south of Italy simply be disregarded in favor of those regions where investments make a return? What impact might this have on the political stability of Italy and through it on the international value of the euro? EMU does not by itself guarantee the transformation of social labor power into a productive and profitable resource. Besides, capital does not possess unemployed labor as an exploitable resource, but posits it as a reserve army whose mere existence bites in the profit margin, in the suggestion that, under EMU, unemployed labor might migrate to the areas of employment smacks of desperation. However painful the consequences might be, in sum, national shifts in the balance of class power will have immediate effect on all other member states due to its impact on the euro and through it on monetary relations across Europe. Quite apart from the impact of global shocks on the EU, EMU transmits and amplifies domestic resistance to austerity and exploitation in member states to all other member states of the Union and beyond. In short, EMU merely provides a supranational anchor for the pursuance of a politics of austerity. Whether the anchor fulfills its role does not depend on the melody of European integration, but on the outcome of class struggle. EMU transmits and amplifies domestic or regional conflicts across Europe, and therefore makes the European state much more dependent upon each other. Failure to contain the labor question in one state has direct adverse consequences for all others. In other words, each national state not only competes with the others for competitive advantage, but also depends on the others for containing class struggle. In literature, this issue is addressed in terms of moral hazard. Should member states or the EU support expansionary responses to class conflict by a member state through the fiscal transfer, thereby setting a precedent that would encourage the expectation that a similar response will be repeated in the future? Or should member states be allowed to default? Whatever response, each of its own terms will jeopardize European monetary stability and union. This might not only destabilize global financial relations through speculative runs on the euro, but also deepen the crisis of capitalist accumulation on global scale. There would thus be strong pressure to create a European fiscal competence, a fiscal federalism complementing monetary federalism. Such a development, as Hayek saw clearly, would be painful to profits and render problematic the containment of the European working class through territorial fragmentation. The stability of EMU depends on the acquiescence of European working class. Domestic resistance to deteriorating conditions have not only repercussions across Europe, but also on a global scale through the effects of discontent on the value of the euro. The failure of one member state to contain its working class has costly consequences for all other member states. The former president of Bundesbank, Mr. Teitmeier, saw this clearly when he said that the sustaining of the monetary union may need perhaps more solidarity than beginning it. In short, the fabric of EMU appears strong, yet the seam is weak. The seam is all important. EMU, in conclusion, reproduces in different forms the very conflict it sets out to resolve. The question, then, of Europe is not resolved by EMU. Rather, it is posed.